Welcome to the PRM lecture series, and our today's topic is valuing forward contracts. Before I start, let me introduce myself. My name is Saeed Adnan Huda. I'm a CFA charter holder. I also hold a master's in economics from City University of New York. Currently, I'm working as a fund manager in an asset management company in Bangladesh. For the exam, from this chapter, you're expected to know spot price, forward price. You must be able to compare and contrast forward with futures. You must be able to calculate forward contract at expiration and prior to expiration. You must be able to describe the impact of cash flows, storage costs, convenience yield on the value of a forward contract. You must also be able to calculate forward price of a bond, stock, currency, and commodity. You must also be able to define forward rate agreement and calculate them. Forward and future, they both are derivative instruments and almost similar in nature. They both are agreement to buy or sell an asset for a certain price at a certain time. A future contract is traded on an exchange, whereas a forward is traded over the counter, OTC. A future is more standardized, a forward is more customized. In both cases, there are obligations to buy or sell an asset. Let's say you are a farmer producing wheat, and you are worried there will be overproduction this year and the price of wheat may fall. So you want to lock in a price in which you will be able to sell your wheat when they'll be ready. So you went to the exchange, got an agreement to sell the wheat when they will be ready for delivery for a certain price. And that's exactly what a future is. And if you would have done it over on the OTC market, that would have been a forward market. So let's say you sold that wheat when they will be ready for delivery for $109. And after 6 months, when the wheats were ready, in the spot market, the price of the wheats were $115. Since it's an obligation, you still have to sell your wheat for $109, although the price in the market was $115. In this slide, we'll go over the basic formula for pricing and the notations. For continuous compounding, it's f of 0 equal to s of 0 e to the power r times t. And for discrete compounding, it's f of 0 equal to s of 0 1 plus r to the power t. The s of 0 is the spot price or the current price in the market. T is the time remaining until maturity or expiry. And r is the risk-free rate that's applicable for that maturity period. So let's go over an example here. A wheat farmer is worried about overproduction and want to lock in a profit. Currently, wheat is trading at 100 USD, so S of 0 is 100, and risk-free rate in the market is 7%, and he is expecting the wheat will be ready for sale is 1 year, so the time to expiry is 1 year. What would be the forward price? So the forward price would be 100 e to the power 0.07 times 1, which is roughly $107 and 40 cents or something. And for discrete compounding, it is 100 times 1 plus 0.07 to the power 1, which gives us roughly $107. So the continuous compounding, it will be higher than the discrete compounding. In this slide, we'll go over the value of a forward contract at initiation, at expiration, and prior to expiration. At initiation, since no money changes hand, the value of a forward contract is almost always 0. And at expiration, it's basically the spot price at expiration minus the original or agreed price that you went to the forward agreement for. And the hardest part is value prior to expiration, which is basically, let's say you went to the contract for 1 year and it's 6 months now and you want to sell, you want to close out your contract. So basically what you do, you discount the original forward price to 6 months and you subtract that from the spot price that's in the market at that time. We'll go over an example in the next slide. So let's continue with the previous example where the wheat was trading at 100, the risk rate was 7%. We already calculated the forward price to be 107. It was S of 0 times 1 plus R to the power T. So it's 100 times 1 plus 0.07 to the power 1. It comes out to be 107. And they're also saying the spot price at S of 0 This was 100. S of 6. 6 was 105. And S of 12 was 106. And we calculated the forward price at expiration was 107. It was 0 for 12 months to be 107. So the value of the forward contract at expiration was 106 minus 107 equal to minus 1. So the wheat producer, or basically the farmer who actually sold the contract, is the gainer here, because he sold it and the price he sold it for a higher price than the price that was available in the market. And for the 6 months, the calculation for the 6 months, we calculated that for after 1 year, the forward price would be 107. So we have to discount it back 6 months to be here. So how do you do that? If we discount it by 107, by 1.07, which was the risk-free rate, and we discount it for half a year, and so it's half. So it comes out to be roughly 103.44. And the value at this time would be 105 minus 103.44. That's 101.56. So the long position is the gainer. So basically, if the farmer wants to close his contract after 6 months, he would have actually lost money. He would have been loser by $1.56. And at initiation, since no money was changing hand and everything was based on this, it's always 0. I really hope you enjoyed the video. For more videos in this series, please log into my site. Thank you.